Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. The most recent government infrastructure forecast is that the UK will need $600 billion of infrastructure investment over the next 10 years, half of which is expected to come from the private sector. Over the last 10 years, the infrastructure and renewable energy infrastructure investment company sectors have grown by over 700% to over 16 billion of assets in May 2019. Today, I'm delighted to be joined by three investment company managers: Frank Schramm, manager of BBGI, Philip Kent, manager of GCP Infrastructure Investments, and Giles Frost, manager of International Public Partnerships, to discuss their outlook for the infrastructure sector. Right, on to the questions. Giles, can you explain your investment strategy?
It's very simple, really. We try and provide the highest quality, longest dated, most inflation-linked revenues and dividends to our investors as we can. And we do it by investing in the essential assets of our communities' infrastructure.
Right, Phil, what's your strategy?
We're a UK-focused fund that targets any asset class with a public sector-backed revenue stream. We target three main sectors: renewables, which makes up about 65% of the portfolio. Example of that is the recent investment in the Racebank offshore wind farm. PPP, which makes up around 20%, and the remainder's in social housing.
Right, and Franks, what's your strategy?
We've got a very boring strategy. We invest in social infrastructure only, which means we invest in roads, schools, hospitals, justice facilities. We do that worldwide.
Great. Now, Frank, what are the benefits for investors of investing in infrastructure investment companies?
The general benefit is that you've got long-term, stable, inflation-linked cash flows. And the specialty for us is, if you invest in BBGI, is that you've got a global footprint. So we invest in Australia, in the US, in Canada, in Germany, in Norway, in Netherlands, and actually in the UK. You can see that's all AA and AAA rated countries. And the revenue streams come from public sector counterparties. So in generally, we are very independent from general economic cycles and also volatility of stock markets. And that's the beauty for many investors, that you have stable, long-term, predictable cash flows coming from the public sector revenues globally.
Yeah, well, that does sound attractive. Phil, have you got anything to add to that on the benefits?
I think particularly in relation to investment companies, the closed-ended nature of those companies means that what are very illiquid direct infrastructure investment assets sits quite well within that closed-ended structure. There's a good liquidity match between the timescales on which infrastructure assets can change hands and the protection of cash coming back to companies, and how the shares are traded on from a person-to-person basis rather than having to give cash back to investors when they redeem.
Yeah, well, the suitability of investment companies for liquid assets is particularly important. There are some high-profile incidents in the open-ended world where that hasn't worked so well. Of course, with our closed-ended structure, fixed number of assets in issue, investors buying and selling on the stock exchange, managers can just focus on the long term on their portfolios. Right, onto the risks, Giles. What are the risks of investing in infrastructure investment companies, particularly the political risks?
I think it's really important that investors understand the different sorts of infrastructure. So there's a world of difference between perhaps a toll road, where you are relying on users to pay for that road, and there's obviously some uncertainty as to how many users will use that road in the future, and an asset where you're effectively being paid a rent by a government body simply to use the asset. We tend to work on the lower risk assets, such as Thames Tideway Tunnel, which is a big sewage pipe being built under the Thames. We've got investments in railway tunnels in Belgium, for instance, in military housing in the US. You mentioned political risks. I think there are political risks in the sense that infrastructure is inherently a political asset class. We're all interested and all have opinions as to what infrastructure our countries need. But the great thing that dilutes those political risks is the fact that infrastructure is such a long-term asset. And once built, infrastructure should give a long-term revenue for 25, 30, maybe even 50 years. And that's what we're trying to do for our investors.
Yeah, long-term good for everyone. Phil, risks for you?
I think we divide risks into four main buckets. So market risks, so to the extent assets are exposed to changes in electricity prices or inflation. If taking a wind farm, for example, part of its revenue is linked to electricity prices. The second bucket is credit risk. So this is recognising that every asset relies on third parties to deliver services as part of monetising that asset, whether that's building the asset or operating the asset or off-taking the services provided by an asset. So therefore you're reliant on those parties continuing to perform those services to deliver value. Thirdly, operating risk. So these are living, breathing assets that need to be operated, and there's different levels of complexity in doing that, and we have to recognise that as part of our investment. And then finally, as Giles mentioned, political risks, which as a UK-focused fund, I guess we're directly exposed to changes in the political regime in the UK, and then more specifically, infrastructure often relies on some form of government support, whether that's capital support or revenue support or a more bespoke model of support, and therefore the continuation of that support through the asset life is critical.
Right. So, Frank, what's your investment outlook?
We are globally diversified. I mentioned that we actually operating over 3 different continents. And while some countries like UK actually have put maybe a more stalled pipeline or reduced pipeline, in other countries are very vivid, and lively pipeline available. Especially if you go to Canada, which is one of the light towers when it comes actually to infrastructure investments, but also Nordic countries, Norway, they've got a pipeline, Germany, Belgium, Netherlands, and there's an emerging market in the US. We still joke actually that there are more conferences than there are deals in the US, but we still we see that there's more deals coming in the US in our favor. So we are very confident that the pipeline with our global platform is sufficient for our growth opportunities.
Interesting, there's a growing market in the US. Phil, what's your outlook?
So you mentioned the National Infrastructure and Projects Authority pipeline of 600 billion that was identified for the next decade or so of UK infrastructure. That pointed to around 300 billion of private sector investment required as part of that. On top of that, we have increased climate change commitments, so net zero by 2050, which point to a massive transformation in the way we use energy or heat or transport. So there's a significant investment requirement across all of those sectors. I think from a UK focus, the question for us is how policy will support that and what mechanisms a government will introduce to do so. The recent infrastructure finance review we think is an interesting exercise by the government to move away from models like PFI and PF2 that have historically served infrastructure and look at new models. So we'll look closely at that and hope that goes some way to promoting that huge potential for infrastructure development.
Interesting, a lot of demand for infrastructure, 300 billion.
Sure.
Giles, what's your outlook?
Well, I think 300 billion is the tip of the iceberg. I think we are, in a sense, at the sort of start of a perhaps 10, 15, 20-year period, which is an inflection point in infrastructure investment. I think when you look at the drivers for new infrastructure, firstly, you've got the fact that we've been through a period of historic underinvestment in our existing infrastructure, not just in the UK, but overseas as well. So that drives the need for improvements in our roads and our railways. We've got technological change, we've got electrical vehicles, we've got the changes to our energy networks that need to support electrical vehicles and the decarbonisation of our economy. We've got demographic change, changing the nature of the housing we need. We've got the need for more housing more generally for the population. There's a whole host of major drivers for infrastructure investment. And the level of investment cannot possibly be met by just public capital alone. So a hybrid solution of public and private capital is going to be the solution. So I think infrastructure investing has been around for our fund now for 13 years, but actually we're only on the cusp of the opportunity.
I think it's very interesting as you hear the economic drivers you could imagine, the social drivers, but also environmental drivers. And I think that is often discounted when you think about infrastructure investments, but that seems to be a key driver of change going forward.
Well, when we look at our Thames Tideway tunnel investment, for instance, which is this new sewer, which will prevent the raw sewage that goes into the Thames on a regular basis flowing into it, the Thames will effectively become one of Europe's cleanest rivers. There's talk about having swimming and rowing competitions in the Thames, which was unthinkable a few years ago. So the environmental change is a big part of it. And I think more widely, as we start thinking about ethical investment policies for portfolios, and many investors now are thinking about the ethical impact of their own investments, infrastructure ticks that box too.
Excellent. Well, that all sounds very positive. I'd like to thank our managers very much for joining us today. It's really encouraging to hear their positive views on what they think this year and beyond may hold for infrastructure. I'd like to emphasise that we don't know what's going to happen in the future. Investment is for the long term and you need to have a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. Thanks so much for watching.